Okay, so let's talk a little bit about the review for chapters 11, 13, 14, and 15. And I need to share my screen here with you so that you can see um, chapter 11. And so obviously I've got 40 minutes here to talk about this, and that's not a very long period of time. So I'm going to try to just hit the highest points that I think that you will see on your examination and need to know. And so let's start with notes given to extend a credit period. And a lot of times what will happen is we may need some extra time to pay for a bill. And so we ask a company to extend the amount of the payable, and the company will usually say, well, yeah, we could do that, but what we want to do is we want to charge you some interest. And of course, that makes sense. And in this case, what's happened here, if you look at the screen, is that they paid $100 to get the accounts payable from 600 down to 500. So now we have a note payable that attaches 12% interest for 60 days, and that's up here in the body of the requirements. We have a 60-day 12% note for $500 that we're going to have to now pay. And so when we get to the point where we have the interest is to be paid and the note is to be paid, then we have to recognize that $10. And in this particular case, what you have is 500 times 12 times 60 divided by 360. Or if you want to think about it like this, because it's a 12% note and there are 12 months in the year, it's 1% per year, or 1% per month, I'm sorry. And so 500 times 1% is $5 times 2, which is 60 days, and gives you the $10. And then you're going to pay out $510 in cash. Now, this is not a whole lot different, by the way, than when you get a loan for your car or a loan for your house. The only difference is that typically we include the amount of interest for every month. So that's part of your payment, the interest payment. Here in this case, because we're doing it on a note, it's only going to be paid at the end of the time. Now, I have to just very briefly let you know that in many cases, when we go into these notes payable and notes receivable and so forth, especially if we go down to the bank and say, I need to borrow $2,000. Well, sometimes the bank will say, all right, how about if we discount the note and therefore we're going to only give you the amount of money that excludes the interest. So just take a look at this one that's in front of you. Assume that's a note receivable that we're getting, or note payable we're going to pay to the bank later on. We're getting cash. So instead of getting $500 in cash, in that particular case, we would get $490 in cash, and we would pay back 500. So the interest was taken out up front. Now that's an unusual situation, but it does happen. Okay, so I don't want to dwell on that so much. I want to really get into employee payroll deductions. This is something be near and dear to your hearts as you go forward, of course. And many of you who have already worked someplace know that you get paid a certain amount of money, call it $20 an hour, but you don't get $20 an hour because they take things out of it. And the first thing that comes out of it is FICA taxes. Social Security is another term for FICA taxes. And OASDI is another term, old age survivors and disability insurance, OASDI. So you'll have it referred to in all those different ways. Now, Social Security taxes are 6.2% on the first $128,400, which what that means is that once you have earned in a given year over $128,400, you are no longer taxed on Social Security on that 6.2%. Now contrast that with the next one over, the Medicare taxes. And Medicare taxes are Not that way. You pay Medicare on every single dollar that you earn, no matter what that dollar amount is, and the employer has to match it. The employer also matches up to 6.2% of 128,400, the Social Security taxes as well. Going forward, we have voluntary deductions, and those would be like your health care deductions. If you belong to a union and you're paying union dues, might go through there. If you have any kind of supplemental insurance like life insurance that you have to pay for, or disability, short-term disability, long-term disability, all those sorts of things would fall under the category of excuse me, voluntary deductions. Excuse me. Also, then we have state and local income taxes that come out, and also then federal income taxes. And when they've taken all of that out, what is left is the net pay. Okay. All right. So let's see here. This just gives you the amount that's going to be withheld. In this case, the FICA Medicare taxes are 1.45% of all wages, irrespective of how much that is. Federal income tax is paid only by the employee, okay? And then, of course, any voluntary deductions that you have, and they've given you a listing of some there, and they will, on problems on your examination, which there are, by the way, 50 problems, 11 of those problems come from this particular chapter, and it's heavy in the area that I'm in right now. Here's the way that we record an employee payroll. And so we're just taking one individual, and that individual is paid $2,000 for this particular period. And so they have withheld from their check some FICA taxes, and notice that it's taxes payable. And the reason this tax is payable is because the employee is not paying those taxes directly to the government. The employer accumulates all of those taxes for all of his employees or her employees, and then remits them in one amount to the federal government. So in that sense, the employer is a fiduciary of that of the Social Security taxes. Also, the Medicare, you see that is also payable. Federal employee income taxes is payable. Medical insurance premiums will have to be paid to the carrier, that's a payable, and the union dues payable. And then whatever is left is the salaries payable, and that's going to be the amount that is paid directly to the employee. All of these others up and through here will be paid to the various agencies and so forth. And here's the entry to record the journal for the cash payment. In this case, the salaries payable debit once you pay it of $1,524 and cash of $1,524. And again, this is the $1,524 is the amount that the employee will receive on his or her paycheck. Okay, now employers also have payroll taxes, and what they have to do is they have to match 1-for-1 every dollar that the employee pays for Social Security or Medicare. Okay, so if the employee pays $6.20 on the first 100, then the employer has to pay $6.20. The same thing is true on the 1.45 on the Medicare taxes. Also, now we have federal and state unemployment taxes. These federal and state unemployment taxes are paid by the employer. Now, that's not absolutely true, because if you live in some states, and I want to say Minnesota may be a state like that, that they also get some money from the employee, and the employee will have to pay out of his paycheck or her paycheck. They will have to pay a certain amount, and the reason they do that is because the unemployment payments, if you're unemployed in the state of Minnesota, are quite high. So the employer and the employee both have to contribute to unemployment taxes. But that's really the exception rather than the rule. Almost everyone, almost every state pays through the employer only these federal and state unemployment taxes. And the way that it works is it's 6%. on the first $7,000 for federal unemployment. However, they almost never pay that because they get a credit against that 6% of 5.4% for any amount that they paid to state unemployment. Now, state unemployment, this 5.4%, is almost never charged either. And I don't want to get too far in the weeds here, but basically you have an experience rating, and that experience rating gives you a reduction generally down to around 2.7%, but you get the credit of the entire 5.4% against the federal unemployment. Okay, one last thing I want to talk about here, but be very careful that you understand how those payroll taxes are computed and how they are recorded, because there are, I think, 11 questions from this chapter, and almost all of them come from payroll type stuff. Okay, here are 4 critical areas of internal control that you have to make sure that the employee hiring and payroll preparation, timekeeping, and the payroll payment, those are all separate. So I'm going to stop the share on this particular one, and I'm going to bring up another one. Okay, so now you should be looking at accounting for corporations here. And this is chapter 13, and most of the questions related to the corporations have to do with their form. It's a entity created by law. Its existence is separate from its owners, and it has certain rights and privileges. It can be privately held, it can be publicly held. Some of the characteristics, again, are limited liability. It's a separate legal entity that is separate from its ownership. Therefore, if you sue the corporation, you might be able to bankrupt the corporation, but you cannot bankrupt its shareholders, its owners. You can transfer ownership rights, and usually that's done through the stock market. So you sell your shares of stock, somebody else buys your shares of stock, and so forth. It has continuous life. There's no mutual agency for stockholders, meaning liability. And it's easier to accumulate capital. However, the corporate taxation rates are generally higher, and there are numerous government regulations that you have to abide by. Rights of shareholders, you get a vote, and usually you don't go to the headquarters to do that unless you have just exorbitant amounts of shares. You usually give someone the proxy that is the ability to vote your shares for you. You can sell your stock, you can purchase additional shares, you can receive dividends if you're entitled to them, and you can share in any assets remaining after creditors in case of a liquidation, so that if the company goes bust, then you can actually receive whatever's left of that liquidation, okay, when it's closed down. Okay, so a lot of times we talk about par value, and people get that confused with market price. They have nothing to do with one another. When a company is established, it's often established with a par value, say $1. That has nothing to do with the value of the shares. What it does have to do with is makes it easy to calculate the amount of common shareholders there are. So if you had $1 million in par value, and you had a $1 par value share of stock, that would mean you'd have 1 million shareholders. And that's all that they really use that for. The market price is different. That's what the market, that's what the price of the shares are in the market. So if you look at, I don't know, Boeing as an example. I think yesterday a share of Boeing cost you $126 and change. And Boeing, by the way, the reason I pick it is because it represents about 1% of the Dow Jones. It's a very large stock. Um, Stockholders' equity. Now, this is where it gets more confusing and I think more difficult for young accounting people, because here we're talking about how the equity is made up. And what we've looked at before had nothing to do really with retained earnings and paid-in capital. But paid-in capital is what we receive when we're giving out shares of stock. And so remember that you have this par value, right? Okay, so, and let's see if we've got something here that I can show you. Here's issuing par value stock at par. So let's say that we issue 30,000 shares of $10 par value stock for 300,000, and that's simply 30,000 times 10. And so you have cash and you have common stock. Now, this almost never happens this way. Usually it gets issued at maybe a premium. So in this case, we have the same 30,000 shares issued, $10 par value, but it's issued at $12 a share. So now we get 12 times 30,000 or $360,000. The common stock is always going to be recorded at the par value or 300,000, and the difference between the 360 and the 300, this is paid in capital in excess of par value. And so we keep that in a separate account. And therefore, what we can do is we can look at the common stock par value, always keep it constant so we know how many shares of stock are outstanding. Let's see here. I know I don't have any no par value stock or stated value stock. You can look at those things, and if you have interest in going forward in accounting, of course you want to look at all of this stuff in great detail. I'll just very briefly talk about accounting for cash dividends. And so when you have a cash dividend, there's a declaration date, there's a date of record, and there's a pay date. And the declaration date is when I say I'm going to issue $1 per share common stock on the 5,000 common shares that are currently outstanding. And it'll be paid on February the 1st, okay? And February 1st is the date of payment. So this is the date of declaration, January the 9th. This is the date of record, January 22nd, because they have to know who they're going to pay as of a certain date. So if I own the shares on January the 22nd, even if I sell them on the 23rd, I'm going to receive this $1 per share for every share that I own. And whoever buys the shares on the 23rd of January, they are not going to get, they're not going to get that. However, they should probably be thinking about it and reflect that in their the amount that they're willing to pay for the shares of stock. Because if I'm not going to get the dividend, somebody else is, I'm going to be willing to pay less for it, if you think about it. Be sure you look at the stock dividends and recording the stock dividends. These are important, especially when you have an interest in going forward in accounting. I'm trying to remember, but I don't think that there are any questions related to that. So I'm going to stop this share and I'm going to move on to the next one now. Okay, so now we're going to talk about long-term liabilities. You remember that current liabilities are liabilities that are due within a year or the accounting cycle, whichever one is greater. And typically it's a year. You might see a difference in the accounting cycle when you have construction projects and things like that. So in this case, what we're going to be looking at a lot is bond financing, and it's different than preferred share financing. With preferred shares, what you have is you have a dividend that's stated, but the company's under no obligation to actually pay those dividends. If they stop paying dividends entirely, then the preferred shareholders don't get them. That's different than this because these are actual outside creditors. And the outside creditors are going to get their interest, or they have the ability to stop the company from working. They can actually force a liquidation if they don't get their money. Okay, so some of the advantages of bond financing is bonds do not affect owner control, so they have no voting privileges. The interest on bonds is tax deductible. Bond can increase return on equity. And that's a question that the return on equity that it can do. That's really a question that you'll see raised oftentimes in your finance classes. I'm not going to get into it here, but just know that they can increase the return on equity simply because they don't have ownership privileges, and therefore, they're not equity instruments. So my equity can move up faster than, even though I've got the money that I might have otherwise gotten from selling more shares of stock. So I don't have any dilution in the number of shares of stock that I have. That's principally what we're talking about there. Disadvantages: bonds require payment of both periodic interest and par value at maturity. So, and they can potentially decrease the return on equity if you have too much of it. So, again, this is something that you'll be seeing more in your finance class than you will in this particular class. Okay, issuing bonds at par, that's when we have a stated value, in this case of $100,000, and we get $100,000 cash for them. And the stated interest rate, if you look up here at the top, you'll see is 8%. What that really means, if I'm selling these at par value, that really means that the interest rate that people can get on other bonds of this type from a company of this size and quality will be 8%. So I don't get any premium, or I don't have to give any discount if I'm selling them at 8%. Looking very quickly, here's the interest expense, and notice that this is one of the things that you will see on your exam, and you want to make sure that you understand and are doing this correctly. In this case, they're going to pay the interest every half year or twice a year. So the 8% is per annum. They only get half of that on every interest payment date. So notice here that instead of being $8,000, it's $4,000, and they'll get another one of these on probably December 31st. When you pay it, of course, that's when you're going to pay out the bonds payable and cash of $100,000. Now, notice that what you have is the interest has already been paid, so that's a separate kind of that's a separate concern that you have. Okay, here's bond discounts and premium. Now, this is one that I tested over fairly significantly, I think. Okay, so the bond price is determined by the contract rate and versus the market rate. So if the contract rate, that is the stated rate, and let's just give a stated rate, say it's 10%. And for companies of its type, the market rate that everyone else is paying is 8%. So if you buy my bonds, you get a 2% higher interest rate. Or actually it's 25%, but we don't get into that. 2 points higher on the interest rate. So that being the case, I'm going to require my bond to sell at a higher value. So instead of selling at 100%, I might sell it at 102%. Now, if it's the market rate and the contract rate are both 8%, like we saw in that previous example, then the bond sells at par. And if the contract rate is less than the market rate, so using the same kind of an example, if the rate on my bonds is 6% and the market rate is 8%, no one's going to buy my bond at par. Nobody's going to buy it at full price. They're going to want a discount because the interest rate is lower. And this is just an example of it here. Par value is 100, the issue price 96.4%, or And this $100,000, $96,400 is what you're going to get. And that's because the market interest rate is 10 and the stated interest rate is 8. So we have to sell it at a discount. Okay. Now, one of the keys is how we deal with this discount of 3,600, and it becomes a discount on bonds payable. And so we get only 96.4 in cash, but I have over here $100,000 that I have to pay back. So that difference between the 96.4 and the 100,000 is going to be treated as a discount on bonds payable. And what that will do is that actually on that discount, it actually increases my interest expense as we go forward. If I have a premium, then it actually decreases my interest expense. And I don't have time to do this in this particular short thing, but if you will take an opportunity to go through, and I would look at these slides from about 17 through, looks like about 23, 17 through 23, pay particular attention to those because I know for a fact that I have several questions related to that. Okay, let's see here. If I want to talk about anything else in this group. Just because I'm not talking about it doesn't mean you won't see it, because anything that is on, anything that's on these slides, you have responsibility for. So debt to equity ratio is something I do like ratios, and I think that I've got among the 50 questions that valued at 0.4 of a point each. I think that you will see multiple questions on ratios. So anytime you see a ratio, you want to make sure you understand how to work it, and you have to work it like it's worked on the slides. Now there's sometimes differences in the way that people calculate these ratios, but from a question and answer perspective, it's based on the way your book does it. Okay. So here we have total liabilities over total equity. That gives you your debt to equity. Should be less than 50%. If it's greater than 50%, then you probably got a serious problem in terms of debt to equity. And of course, if you can get away with it, that's fine, but usually around 50%. Think about for a second in the current environment that we're in, okay? And the current environment is that everybody they basically close, or most people had to close. So now in order to get started again, then they need to enter into more debt. And people may be unwilling to give them more debt if they have high debt ratios already. So in my estimation, the best thing to do is to always stay under that 50% debt to equity ratio, and then you shouldn't have any problem going forward. Okay, I'm going to stop this share and I'm going to look for the last one then. Well, I might not have put it up there. Let me see here if I can find it very quickly here. No, that's not it. It might be in here. All right, chapter 15. Okay, so enable it here. Let me pop back over here to the screen sharing, new share, and see if we can find 15 here. All right, okay, so we should be sharing 15 now. All right. We want to distinguish between debt and equity securities and between short and long-term investments. And so I can tell you that the difference between debt and equity and your your book gives you an excellent um, breakdown of those two things right here. There's no creditor relationship with an equity security. I'm just selling stock, and stock can go to zero. If I buy 100 shares of stock at $10, I have 1,000 shares or $1,000 in stock. If that stock goes to zero, I'm just out $1,000. Okay, that's different than a debt security. We have a creditor relationship. Okay, and creditors can force you into bankruptcy. So some examples: investments in notes, bonds, and CDs. Down here, equity securities, investments in shares of stock. These are issued by companies, and debt securities can be issued by companies as well. Can be issued by companies, but they're also issued by governments, individuals. Governments would be things like if somebody in Tifton, Georgia wants to, if a government wants to build a new set of sidewalks or put up some new street lamps or whatever, in order to finance that, they might use a debt instrument, a bond, and then they make the bond available for people to buy, and people buy it and they pay them interest. And the good news is the interest is on a municipality like that, there's no tax impact, so you get it tax free. However, they also recognize that they're giving it to you tax free, so you get a lowered interest rate. Okay. So classification and reporting, it depends on whether it's a debt instrument or an equity instrument. Of course, debt instruments are going to appear up in the liability section. Equity instruments will be in the equity section, obviously. And take a look at this slide because it's pretty important. Here's the acquisition of a debt instrument on July the 1st of 19. Ling paid $30,000 to buy Dell's 7% two-year bonds payable with a $30,000 par value, which means that the 7% interest rate is the market rate. And so that's also the stated rate. So there's no difference between the two. So they're going to sell at par. Okay. And so in this case, $30,000 is the debt investment, and cash is going to be the amount of money that we put out. Okay. The bonds pay interest semi-annually, and this is probably the key portion for you to remember. So if I look at 7% of 30,000, that is, what, 720? And so, but it's not going to pay 720 each time because it pays twice a year. So if I come down here, I don't know whether they're going to show it or not. Maybe they will. I guess they're not. But what you're going to do is you're going to take that and divide it by 2. 7% times 30,000 divided by 2, and that will give you the amount of interest revenue and interest expense on the other side. Okay, let's see here. Trading, reporting at fair value. I know I'm going through these very quickly, but it's a necessary evil. That's not really what I wanted to talk about, though. I don't know that I've given you many questions on that. Here, I've given you lots of questions on this one. Okay, on these actually. Recording acquisition and dividends and fair value when the investment is insignificant. Okay, and so insignificant means something very specific, and so it's less than 20%. And let me just show you this one right here. This is insignificant influence. That means how much influence you can actually push on a company if you own shares. And so if you have shares of stock that are less than 20%, it's treated as insignificant. Significant influences is between 20 and 50. And if it's more than that, then we have to use the consolidation method. in order to account for it, because basically you own it. Okay, if you own more than 50%, then obviously you own the controlling interest in the company. So you don't treat it as an investment anymore. In that sense, you consolidate the company. And for any of those of you who are eventually wanting to become CPAs or whatever, better look at consolidations pretty heavily, because they're always on there. That's usually one of the several sections of practice that you have to master. Okay, so when we get these investments, we record them at cost. Now, these are insignificant ones, right? Including any commissions and brokerage fees. So ITI purchased 100 shares of Links for $7,000, and typically you're going to pay a brokerage fee in there as well. So it might be $7,050 or something like that, because a brokerage fee will be there. Then on 1/1 or 11/1, they received $10 in dividend. So it's just dividend revenue in cash, just like just like regular revenue. Nothing really changes. And that's really the key item, because it's less than 20%. It doesn't really have that much impact on you. Okay. Now, we do have to record fair value. So in this case, it has a cost of $7,000, fair value is $9,000. That means that it would sell on the market at $9,000, those $7,000 worth of stuff, that shares that you own. And so you have an unrealized gain of $2,000, difference between the 9 and the 7. So you have a fair value adjustment on the stock debit and an unrealized gain to the income credit. Now, remember, this is done for comprehensive income. You didn't sell it. You didn't get any money. And therefore, it is unrealized. It'd be realized if you sold them. Okay? All right. Let's, when you sell them, of course, it's done just like any other share of stock would be sold. If you have proceeds and you have $300 worth of gain. Now, this is a realized gain, okay? Not an unrealized gain. You're selling these stocks. So you're going to get the $800. In the other instance, you weren't going to get the $9,000 unless you turned around and sold it. Okay, so going forward here, what I want you to understand is that there are a significant number of questions that deal with these equity investments and whether they are insignificant or significant influence or ownership influence. So you want to walk through all of these, let's see, starting on 25 and going all the way through until you get to controlling influence and the end of that in comprehensive. So 25 to 42, and again, I don't have time to go through all of those in a 40-minute presentation, but you want to make sure that you have looked at that, because there are numerous questions in that area. Return of total assets, and again, these are ratios, right? So you want to take a look at the profit margin ratio, which is net income divided by net sales. Asset turnover, net sales divided by average total assets. What do we mean by average total assets? Well, the assets at the beginning of the year plus the assets at the end of the year divided by 2. The return on total assets is net income divided by average total assets. And I can promise you're going to see questions on those ratios. I think a lot of ratios, because they are really important to you going forward. So I make sure that I test them pretty heavily. So make sure you're looking at that. And that's it. So I'm going to go ahead and post this thing, and we'll send it to YouTube and give you the link for it.